Hello, good evening, and welcome to another series of our monthly webinar on equity market insights, where our experts talk about the global and domestic markets and their perspectives and insights on the outlook. And we also deep dive into one of our fund's strategies. I'm Sonal Mittal, product specialist at UTI, and I'm joined by our CIO, Mr. Vetri Subramaniam, who will take us through the market updates. And I am also joined with our fund manager, Mr. Shravan Goyal, who will be taking us through the strategy of UTI Multi-Asset Allocation Fund. Before I hand over to Vetri, let me remind you that you can post your questions anytime during the webinar on the link provided. Without further ado, I will now invite Vetri to take over. Thank you.
Good evening, everybody. Thank you for joining us here on this edition of the Equity Market Insight. It's been a pretty busy start to the year, and we are not even halfway through the year. And there have been so many events which have shaken the markets, and of course, also some very sad events resulting in the loss of life. So these are very challenging times that we as Indians have to navigate at this point of time. And our thoughts are with those who are impacted at the border and with our forces who are doing a fantastic job of defending the borders of Mother India. So without any further ado, we'll jump into the presentation for the month. So we'll start off as usual with a little bit of the macro. Now, if you recollect, a few months ago, we were talking about how the election of President Trump was resulting in dollar exceptionalism. The US economy was seen as the strongest economy in the world. The tax cuts were expected to boost growth. The dollar was red hot. And the US stock markets were also very, very hot. Now, interestingly, the entire picture and pretty much the entire gain which happened from the third quarter of 2024 pre-election of President Trump has entirely been reversed. If you look at this chart, this is the chart of the DXY, which is the dollar index. You can see the sharp rise that takes place in the run-up to the election of Mr. Trump. And then from the time he takes office, it starts to sell off. And then once he gets into the tariff war and the trade war, the dollar completely gives up its strength and in fact has broken below the lows of 23 and 24, and even now is sort of flirting with those lows. So this is a very significant reversal, I think, which has happened in the markets, and this has significant implications not just for the US but for pretty much all countries, including India, and we'll see some of that on the next few slides. So jumping through to the next slide, what do you think about when you think about the rupee appreciating? Remember, the rupee had fallen quite sharply in the early part of the year along with that dollar strength, and it had gone past the 88 mark, and it's actually now appreciated from its weakest point quite a bit. Of course, what you see here is a theoretical calculation of what would happen if the rupee were at 86.6, 84, and then 80. The rupee is currently still above 84, but essentially this brings through some benefits to the economy. And you can see over there, because a significant part of India's energy needs are imported, be it coal, be it LNG, or for that matter, crude oil. All of these have dollar prices, and because of the appreciation in the rupee, this would actually translate into savings for the Indian economy. And you can see at the bottom the savings numbers which are mentioned there at different levels of the rupee. And very recently, in fact, the rupee was quite close to the 84 mark. So, these are not insignificant in terms of the savings that accrue to the country. Remember, some of this also has an impact on the budget. Year to date, crude prices have dropped 15%, and the appreciation in the rupee plus the fact that crude oil prices are down 15% would certainly benefit the Indian economy, which is otherwise dependent on global energy resources for its requirements. So this is a positive tailwind for the Indian economy, both a function of the weak crude oil price and also the savings from the rupee appreciation. Moving on to the next slide. Obviously, without doubt, what else is the benefit from a rupee that is well contained, which is not depreciating? It will also convert into benefits in the inflation numbers. Now, why are inflation numbers important? You all know that the Monetary Policy Committee in India has a target of keeping inflation at 4% plus or minus 2%. And the number that they look at to set their target is consumer price inflation, the headline consumer price inflation. And very interestingly, you can see over there that the headline CPI, which is the orange line, has now comfortably dipped below the 4% mark, and therefore is very much in the comfort zone of the MPC. Core inflation, which is the black line, had actually been very, very subdued, because remember, what was driving headline CPI was actually food prices, but now food prices have also corrected, and therefore now the gap between CPI and core has reduced, with in fact core going slightly above the CPI at this point of time. But both numbers are within the target range of the MPC at 4 plus or minus 2%, which gives the policymakers in India a lot of comfort and flexibility in terms of handling monetary policy during such challenging times. Moving on to the next slide. What's the benefit of inflation coming down? What's the benefit of the multiple measures that RBI has taken to increase liquidity in the market? You can see this impact over here. We have just compared the, PSU Bank credit certificate of deposit yield in December 24 to the 29th April 2025 values. And you can see the drop is almost 80 basis points. Even for commercial paper, which is in the middle, there is an 85 basis point drop. And for 3-year AAA corporate bonds, there is a 60 basis point drop. So in a way, RBI now has the ability, in light of the strong rupee as well, or at least no longer a strong dollar, to be able to inject liquidity into the local markets. They've been able to reduce the policy rate. The MPC has reduced the policy rate by 50 basis points. And this is translating into a direct beneficiary for borrowers, not only for the banks, but also for companies. And remember, because of the prime lending rate system, this will also translate into the cost of mortgages and other floating rate loans that consumers take. Even those rates would eventually come down to the same extent that you are seeing here. Moving on to the next slide. Now, as you know, ever since the trade war with the Trump administration kicked off, India has had ongoing conversations with the US about a bilateral agreement. It's not a free trade agreement. We are looking to do a specific bilateral agreement with the US. But interestingly to note that this week, India and UK, after almost, I think, 2 to 3 years of discussion, have announced that they have managed to reach the contours of a free trade agreement between the two countries. Now, it is not very material from an Indian perspective, because the UK amounts for only 3% of India's goods exports. And because India's goods exports are, just about 12% of total GDP, 13-14% of nominal GDP, this is a very small number. But essentially, it creates a template which India can build on to be able to enter into a reasonably, supportive bilateral trade agreement with the US as well. So this will boost bilateral trade with the UK. Yes, UK is a very small economy from that point of view in terms of the benefits that can accrue to India. But as I said, it's a good start and creates a template on which Indian policymakers can build. So moving on from this, we'll jump into our more normal section, which is on market movements. April was a month of recovery. If you look at the 1 month performance, April was a month of recovery for the markets. You can see the bounce back which happened in that month. And in fact, even over a 3-month period, you can see that there has been some rally in the marketplace. And of course, what is noticeable here is that particularly now over the longer term period, again, I don't really mean long term, just 3 month and 1 year, it is actually the Nifty 50 which is leading in terms of its performance, up 7.7% over 1 year, whereas the small cap is actually negative on a 1 year basis. The mid cap index, even though I would say it is challenged in terms of valuations, we'll talk about it more later, is actually not done too badly relative to what the Nifty 50 has done. And if you look at the bottom where we've got the sectoral performances, I would just highlight one thing, which is the 1 year performance of the financial services index and the bank index. You can see both of these are now comfortably outperforming the Nifty 50, the financial services being the best performing subsector of the market, followed by pharma. These have been two sectors about which we had a lot of conversations in 2023 and 24 as being two pockets of value, and it's heartening to see their strong performance at this point of time. Jumping through to the next slide, we'll just jump through. This is more global markets performance. I think we'll just jump through now to the section on earnings and valuation. Yeah. So March 2025 earnings are still coming through. 9% is the forecast for March 25. All the numbers are yet to come through over there. March 26 has started to see some earnings cuts. Remember, this number used to be closer to 13-14%, but with the kicking off of the trade war, and essentially what the trade war does is that it is creating uncertainty. That uncertainty leads to a slowdown in decision making by businesses, and that eventually transmits even down to a consumer level. So I will not say that anybody can have a high degree of confidence in this forecast of 9% earnings growth for March 2026. The longer the uncertainty sustains, the more the risk to the estimates. But people have started to, sort of bring down their estimates for 26 because of the uncertainty. And that's why you're seeing that number drop from, 13-14% growth to 9% growth for 2026, which makes it a pretty average year, if the forecast were to come true. Next, we'll jump through. So what does this look like in terms of valuations? On a trailing PE basis, on the left-hand side, the Nifty 50. What is the Nifty 50? The 50 largest companies in the country. So this is really a large cap index. As far as the trailing PE is concerned, it's very comfortably in the fair value zone. The forward PE multiple has actually moved up from fair value into slightly expensive territory. Simple reason why this has also happened is, remember, the 26 earnings estimate has been cut. So when you cut that estimate, even at the same price level, effectively the PE multiple moves higher. So partly that is what is also reflected in that forward PE multiple going much higher. If you go to the next slide, where we cut out the earnings volatility and only look at price to book, you can see that because of the earnings cut, the PE multiple goes higher, but at the same price level, the price to book, which is a trailing price to book level, is actually pretty much unchanged and is pretty much in the fair value territory. So I think that's the good news as far as large caps are concerned. The Nifty 50, which is a reflection of large caps, is comfortably trading in the fair value zone, slightly above the long-term average. We'll move on to the next slide. This talks about mid cap and small cap. Over here, the situation still continues to look challenging from a top-down perspective. Now, I know sometimes when I do these webinars, somebody will say, oh, but this mid cap is cheap or that small cap is cheap. I'm not disagreeing with that. I know our own fund managers in some cases have been looking at some of those opportunities. I am talking here today as an asset allocator. As an asset allocator, when you look at what looks attractive, then you're looking at valuation aggregates. Valuation aggregates in mid-cap look extremely expensive, massive premium to large cap. So I would say this is the most challenged part of the market. Nifty small cap, not as expensive as mid caps, but still at a premium to large caps and in the expensive zone. So I would say that as well, not our preferred area. It's really the large caps where we have a lot more comfort from a valuation perspective. Moving on to the next slide. As you're aware, at UTI, and Sharwan's team actually runs this model, which is part of our asset allocation model. This is a model we look at how does the Nifty 50 yield compare to the yield of the 10-year GSEC? Now, 10-year GSEC, all of you know, that's a simple number. You will find it anywhere. Currently, the yield is about 6.35%. So what do we mean by Nifty 50 yield? We do not mean the dividend yield. What we mean is a proxy, which is the earnings yield. How do you get the earnings yield of the Nifty? You take 100 and divide it by the PE multiple of the Nifty. So for example, if the PE multiple, which is very close to 20 times today, 1 year forward, then 100 divided by 20, you get a value of 5. So 5% compared to the bond yield of 6.36%. So roughly speaking, the yield difference comes to about 1.36%. Now look at that number. About a year ago or even before, the gap had gone to almost 2%. The historical average is 1.1%, 1.02%. And in fact, at the absolute low that the market had sometime in March, or rather in April, at the absolute low point, the yield difference had gone to about 1.1%, which is very close to the long-term yield difference of 1.02%. So in a way, on a relative basis, equities are now not as unattractive relative to bonds as they used to be a year ago. Putting all of this together, we can move to the next slide. Now, this next slide combines price to earnings ratio, dividend yield ratio, price to book ratio, and the equity versus bond index that I showed you on the previous slide. We combine all of these to create a single equity valuation index, which tells investors when they should consider, the zone to be fair value for equity investing, which is the zone in which they should look to increase their equity allocation, the zone in which they should significantly increase equity allocation, and similarly, when should they start to decrease their equity allocation. If you go back to the second or third quarter of 2024 calendar, you will notice that the equity valuation index was in the red zone, decrease equity allocation. And in April, as I said, at the low point, it actually entered the green area, which is increase equity allocation. Now, Sharwan's team runs this model for us. We track the model for the actions in our balanced advantage and our multi-asset fund, about which he'll talk later. But interesting to note that in the third, fourth quarter of 2024 calendar, these strategies were invested about 46% in equity, but into the sell-off, they raised their equity allocations to about 60 to 63%. So, these two funds, as well as the equity savings fund, respond to this equity valuation index in terms of their allocation strategy. Now, why do we highlight these zones in these particular colors in terms of when to decrease, when it is fair value, when it is the time to increase? This is a probabilistic analysis, which you can see on the next slide, right? So on the next slide, we tell you that in each of these zones, in the decrease equity allocation zone, what is the average investment that you would have made if you had invested in that period? What is the average return you make when you invest, for example, in the right extreme, which is significantly increased equity allocation? The red zone, decrease, is personal to each individual. So do consider your personal circumstances by talking to an advisor, or if you do it by your own, consider your personal circumstances before you determine how to use this. Moving on to the next slide, and I'll conclude over here. The IMF has brought down its global growth expectations by 50 basis points. But, I would say this is just an Excel sheet number. The reality is none of us know how to convert the current trade uncertainty into negative impact on GDP. Because the longer the uncertainty persists, you will get first order impact, second order impact, and third order impact. This is just an Excel sheet and certain assumptions going into these numbers. I think what we have to hope for is that President Trump has also realized how the markets have reacted negatively to his policy decisions, and maybe therefore the final outcomes will not be as extreme as some of the positions they have currently taken. India is less impacted compared to the rest of the world because our export of goods is limited to about $450 billion in an economy which is now coming up close to $4 trillion. So just about 12% of our exports are goods. Remember, all this discussion about tariffs is happening only in the goods segment, not in the services segment. To our mind, therefore, we don't see too much risk to the growth estimate. RBI is at 6.5%, but most professional economists have now cut their estimates to closer to 6%. The US dollar has depreciated sharply in CY25, down 8%. India's liquidity is now very comfortable because of the change in policy by the MPC and the specific actions being taken by RBI to improve interbank liquidity. And I think monetary policy is one of the few areas in which India has the ability to be able to support the growth aspirations that we have, along with the fact that our macroeconomic platform on the fiscal side has been managed quite conservatively. Every year, we look to the monsoons to figure out how our farm sector will do, not because of its impact on GDP, but more because a large segment of our population is dependent on the agriculture sector. And secondly, it has an implication for food prices. The in-house equity valuation index is now back in the fair value zone for equity investing. That's a point I already covered. So we continue to believe that this is an environment in which asset allocation and risk management should be the focus for investors. The hybrid strategies such as balanced advantage, multi-asset equity savings, which are dynamically managed in terms of their equity allocation, we think are very suitable for lump sum investments. But of course, you could also consider a very classic aggressive hybrid strategy, which has a pretty static, 65-68% equity, 30-32% fixed income portfolio, where also you will get the benefit of the hybrid strategy. The reason I say these hybrids are attractive is that the positive carry that you're getting in fixed income, inflation trending around 4%, high quality portfolios yielding you 6.5, 6.8% is a very attractive spread, and you're now realizing that spread in a hybrid product in a very tax efficient manner. And if equity valuations come down, because these strategies that I've mentioned here are dynamically managed, you will automatically see your equity exposure go up if the markets were to see a drop in valuation. Most likely that happens due to a sell-off, and that will therefore benefit your longer term outcomes. Those who are investing, please continue with your staggered approach towards equities through SIP. Even if you want to make a pure equity fund investment in lump sum, we would say make it on a staggered basis. And to repeat again, our bias is towards large caps based on valuations. For almost 3.5 years, value as a style hugely outperformed quality growth in terms of massive outperformance. But starting somewhere around May, June of 2024, we have started to see quality growth pick up. And in fact, I would say for last year, which is financial year 25, both growth and value were more or less equal, but the second half was dominated by quality growth doing better. And we think this is just an initial trend reversal in favor of quality growth. So that sums up the macro picture I wanted to discuss. I'll halt over here and I'll hand over to Sharwan. Sharwan, to those of you who are not familiar, will complete 20 years at UTI next year. He's had a stellar career, starting as an analyst, gone on to lead our equity funds on the passive space, and developed our integrated investing approach for quantitative investing. And that's a methodology which supports some of the funds that he's going to be talking about today. So I'll hand over to Sharwan, and he'll take you through the next few slides.
Thank you, Vetri, for sharing your insight. So we will talk about UTI Multi-Asset Allocation Fund, which provides dynamic allocation across 3 asset classes which are having low or negative correlation to each other. And these 3 asset classes are basically equity, fixed income, and gold. And allocation across these 3 asset classes are dynamically managed based on in-house proprietary financial models. So in the sense, we'll talk about those models which we are going to use for this particular fund in subsequent slides. First and foremost, let me highlight key advantage of asset allocation. Typically, equity has potential to generate high returns, but at the same time, volatility of equity as an asset class is much higher than any other asset class. Fixed income volatility is low, but at the same time, return potentials are also much lower as compared to other two asset classes. Gold has performed well, but at the same time, gold has negative correlation to equity. And generally, gold has performed exceedingly very well whenever equity markets are going through difficult phase. So whenever market environments are extremely turbulent, generally gold provide a lot of protection and provides good returns at that particular point in time. But unlike equity, wherein generally performance is much more smoother across cycles, typically gold performance is much more volatile. So that's why combination of these three asset class provides optimum allocation for an investor. If you look at on right hand side, wherein we have mentioned static allocation across these three asset classes and how the portfolio would have performed. So while equity as an asset class has delivered 13.9% return in last 25-26 years, 65% equity, 25% fixed income, and 10% gold would have yielded 13.1%, which is just about 0.8% lower than equity as an asset class. But at the same time, the portfolio volatility would have fallen significantly from 22% to about 14%. So which means that on risk-adjusted performance basis, asset allocation strategy could have delivered much better outcome. UTI multi-asset allocation is a dynamic asset allocation fund, which means that allocation is not static across these three asset classes. We use in-house proprietary financial model, which helps us identify the right cycle for right asset class. And typically, asset allocation outcome is about 1 to 2% better as compared to static allocation across these three asset classes, which means that following dynamic asset allocation, returns could have been similar to equity, but at the same time, volatility would have been much lesser. So key advantage of UTI multi-asset allocation fund is it provides you access to three asset class which are negatively correlated to each other. So at the same time, rather than following a particular view of the fund house or fund manager, we have developed proprietary financial model, so which takes away human bias of investing. So in the sense, typically all of us are having greed and fear. Typically we become greedy when times are good. At the same time, we become extremely fearful during uncertain market environment. So that is taken out with the help of the model. Third, it provides tax efficient performance, because generally as an investor, if you are investing in three asset class separately, whenever you are changing allocation from one asset class to another asset class, that leads to taxation, frequent tax element, which is taken out in a tax efficient way if you invest in multi-asset allocation fund. So for example, if an investor invests in UTI multi-asset allocation fund today and remain invested for 10-year period, then in this 10-year journey, there is no direct or indirect taxation on the investor, because mutual funds are pass-through vehicles. So which means that the fund will keep changing allocation across asset class, but there is no taxation impact on the investor. So there are three asset classes. So let me give you broad overview of these asset classes. What's the thought process that we follow in UTI multi-asset allocation fund, and then we'll run through equity strategy as well as fixed income strategy of the fund. First and foremost, equity allocation. So unhedged equity allocation could vary from 40 to 80% in case of UTI multi-asset allocation fund. We analyze various factors which could influence market return, but we found that four valuation oriented factors are having consistently high correlation with future market return. So typically whenever market valuations are cheaper, generally forward returns are better, and vice versa. Vetri, while showing our model, he also mentioned that whenever model has signaled significant increase in equity allocation, generally forward returns are better, and vice versa. So that's what we use in UTI multi-asset allocation fund. When it comes to gold, equity as an asset class, you can gauge based on valuation, based on earnings growth, but there is no such element available for gold. Generally between gold and equity, the performance keep varying. Sometimes gold performs better, sometimes equity as an asset class perform better. So we use gold to equity ratio to gauge gold allocation in the fund. I'll walk you through this particular element in subsequent slide. While residual allocation is invested in fixed income, and we follow quality and liquidity approach when it comes to fixed income strategy of the fund. Right. So here we have shown you equity allocation in the fund, how it has moved in last 3-4 years. At the same time, Nifty 50 PRI index on right hand side. So as you can see here, there is indirect correlation between asset class allocation as well as market valuations and market levels. Typically, whenever market valuations are expensive, model signals lower equity allocation, and vice versa, whenever market corrects and valuations become cheaper, generally model signal increase equity allocation. So as you can gaze here that when market was trading at expensive valuation early last year, typically equity allocation was falling, and we maintained about 47% equity allocation till about September 2024. And in last 6 months, we have seen that markets have been extremely volatile. Markets have corrected about 15 to 20% from the peak. So our equity allocation has risen from 47% to 62% in last 4 to 6 month period, mainly because of valuation becoming much more comfortable in the interim. So in the sense, the model has triggered twice. Generally, we follow 7% tolerance band. So the model has triggered twice in last 6 months. So that's why equity allocation has risen from 47% to 62% now. When it comes to gold allocation, as I mentioned earlier, we use gold to equity ratio. So let me broadly explain this slide to you. The green line is basically gold to equity ratio movement in last 15-20 year period. The middle line, blue line, is 10-year moving average gold to equity ratio, while top line is 10-year average 10-year moving average of gold to equity ratio plus 1 standard deviation. Similarly, the green line is mean minus 1 standard deviation. So these lines provides you signal whether gold to equity ratio is extremely expensive or gold to equity ratio is extremely cheap. So whenever the gold to equity ratio is below green line, typically that's the right time to increase gold allocation. And whenever gold to equity ratio is above red line, that's the time to reduce gold allocation. And why I am saying so? Because whenever gold to equity ratio is significantly cheaper as compared to 10-year moving average, typically subsequent 1-year gold performance is much better. So on bottom left table, you can see here, we have mentioned that whenever gold to equity ratio is above plus 1 standard deviation, there are about 10% observations in last 25 years. In such instances, next 1 year gold returns is minus 4%. With just about 17% probability of generating more than 8%. Typically, substitute of gold in our fund is fixed income. So that's why we are showing you what is the probability of generating more than 8% return whenever gold is trading at either plus 1 standard deviation or minus 1 standard deviation. Contrary to this, whenever gold to equity ratio is significantly below mean, which is below minus 1 standard deviation, there are 22% such observation in last 25 odd years. And on an average, whenever gold to equity ratio is below minus 1 standard deviation, next 1 year average gold returns is about 18%, which is significantly better as compared to long-term averages of gold. At the same time, probability of generating more than 8% return is significantly higher at 66%. So in the sense, in UTI multi-asset allocation fund, we use this analysis to gauge where gold is headed, and accordingly we keep changing allocation towards gold in multi-asset allocation fund. Here we have mentioned how gold allocation has moved in the portfolio. So in last few months, gold allocation has fallen in the for UTI multi-asset allocation fund, mainly because gold is trading at above plus 1 standard deviation as compared to 10-year average moving average, 10-year moving average. Right. So the next section talks about equity strategies. So far, we were discussing about asset allocation part of the portfolio. So now let me walk you through what's the strategy that we follow when it comes to stock selection in the portfolio. So we have developed a process called integrated investing, which combines fundamental research with market signals. And by market signal, I mean various factors which perform well in different market environment. And some of the factors are momentum, low volatility, fundamental factors like quality, growth, value, size factors like large cap, mid cap, and small cap. We have seen last 2-3 years, mid and small caps have done much better as compared to large caps. But at the same time, generally, these are cyclical segment of the market. And whenever market environment becomes tougher, these segments underperform vis-a-vis large cap space as well. So we dynamically change allocation across these factors based on long-term study of these factors, based on equity market cycles, and in different market cycles, different factors tend to perform well. Here we have shown how allocation across large cap, mid cap, and small cap has moved in last 3 years in the portfolio. So as you can see here, initially allocation towards mid and small caps was much higher. So in April 2022, we had 63%, which allocation towards large cap, which reduced to 49%, but subsequently it started increasing. And in last 1 year or so, allocation towards large cap was about 77 to 78%, mainly because of the factor approach that we follow in the portfolio. At the same time, relative valuation between large cap, mid cap, and small cap. While in recent review that we have done in the portfolio, mid and small caps valuation on relative basis have become slightly more attractive as compared to where they were. So that's why allocation towards mid and small caps have marginally increased in the recent portfolio as compared to what we were witnessing in last 1 year or so. This is broad portfolio statistics of the portfolio. Just to highlight key elements here. So we discuss about allocation across large, mid, and small cap. 72% allocation is there towards large cap, and remaining towards mid and small cap. At the same time, in last 1 year, allocation towards quality as well as low volatility segment of the market has increased, which led to quality of the portfolio improving drastically. So as you can see here, the allocation towards R1, which shows that 77% of the portfolio is invested in high quality companies, which are delivering more than 18% average ROC in last 5 years. And allocation towards R2, R3 is much lower as compared to what it was about a year back. So in the sense, allocation towards quality and low vol segment of the market has increased, mainly because of very strong performance of momentum and low vol in last 2-3 year period. Moving on to fixed income strategy. So when it comes to fixed income strategy, we believe that for multi-asset allocation fund, there are a lot of levers in the portfolio, right? And generally, asset allocation is dynamically managed. So which means that whenever model signal increase in equity allocation or increase in gold allocation, money should be easily available from fixed income. So fixed income is a residual portion for us. And because of that, we follow quality and liquidity approach of portfolio management, because frequently we may need money to invest in equity as well as gold. So that's why large part of investment is in AAA and sovereign paper when it comes to fixed income strategy. This approach of integrated investing coupled with the dynamic allocation across 3 segments of the market has yielded very good results for us in last 3 years. So as you can see here, since April 2022, ever since we adopted this approach of integrated investing, the portfolio has yielded about 17.1% as compared to 11.9% for the benchmark. Recent performance is slightly weaker as compared to benchmark, mainly because of dynamic market environment as well as volatility in the marketplace. Recent performance of underlying factors have been slightly weaker, which led to slight weak performance in the recent times. But at the same time, long-term performance track record is pretty strong for the portfolio. Moving on to standard deviation of the portfolio. So as you can see here, all time period, the volatility of the portfolio is significantly lower than benchmark as well as equity as an asset class. So in the sense, and that's the merit of you investing in multi-asset allocation fund. It provides dynamic allocation across 3 segments of the market, which are having negative to low correlation to each other. And generally, these 3 asset classes perform differently in different market environment. So that's the approach that we follow when it comes to multi-asset allocation fund. So just to summarize, we believe that in such a volatile market environment wherein global growth environment is challenging, at the same time, geopolitical risks are emerging across the globe. Markets are likely to be volatile in the near-term perspective, and generally, such kind of dynamic asset allocation strategies benefit during volatile market environment, because volatility gives us opportunity to increase allocation whenever markets trade at attractive valuation. At the same time, whenever market rallies, we end up reducing allocation. So generally, volatility is favorable for dynamic asset allocation fund. So I will stop here, and we can open the floor for Q&A. Thank you. Back to you, Sonam.
Thank you, Vetri and Sharwan, for the insightful presentation. Let's begin with the questions, and we will try to take up as many questions in the next 15-20 minutes as possible. Vetri, my first question is for you. With the India-Pakistan escalating situation, what is your assessment on the Indian markets? Historically, we have seen that every time such an event has happened, whether it is Pulwama or the Kargil war, we have seen that the markets have been resilient and managed to recover post the reaction coming into these big events. Now, if the current situation gets escalated further, do you think this could have any bearings on equities? Vetri, you're on.
Yeah, Sonal, a good question, and I know this is a question that many people are asking. Once again, I'll use the same template that we talked about in the context of, the U.S. administration's trade war, which is events like this obviously create uncertainty. Decision making tends to grind to a halt. You worry about the impact of continued conflict on fiscal deficit, etc. But we just released a note, so feel free to ask our any of your UTI-AMC relationship managers for this. We just released a note where we looked at past incidences, about 6 of them over the last 20 years, and how equity markets and bond markets have behaved, immediately after the event and over 6 months and 1 year subsequent to the event. And essentially, what is visible in these six cases is that over time, the markets respond to the starting macroeconomic fundamentals and the longer term prospects for growth. This would be true in the case of equity. And in the case of fixed income, it responds to what it sees as the macroeconomic fundamentals at the point where some conflict broke out, and then how those macroeconomic variables or fundamentals remain stable over time going ahead. But I would say essentially keep in mind that equity is a long dated instrument, right? So equity is not like a bond. You will accrue to you directly and indirectly the earnings that the company earns over its lifetime. That lifetime is not 1 year, it is 10 years, 20 years, 30 years, and 40 years. So because equity is such a long dated instrument, its valuation eventually is linked to a long period and not just to what happens to earnings in a 1 year period. So I would not worry too much about what happens in a 1 year period. But to cut a long story short, the government of India has to do what it needs to do to safeguard the country, to make sure that we are positioned well. There is certainly some degree of escalation. We do hope that eventually at some point, there is a way to get an off-ramp from the escalation. But I would primarily once again reiterate that it's very hard to figure out the nitty-gritty of what will exactly happen. So today, the best way to navigate this is actually to go back to the hybrid funds. You have the positive carry and fixed income. If markets were to sell off, the hybrid dynamically allocated funds will raise their equity allocation, and otherwise they will hold ground at the current valuation levels where they are. So it's impossible to predict, but I think the good thing to remember in the context of India is that our macroeconomic fundamentals going into this conflict are very healthy. And that is what will enable us to focus in an equity context on longer term growth outcomes rather than a single year growth outcome. But certainly there is volatility and you will have to navigate that volatility.
Thank you, Vetri. Shravan, coming to you. What is the role of asset allocation in multi-asset allocation funds and how it helps investors navigate volatility in the long-term wealth creation journey?
Absolutely. So, from long-term wealth creation, it is very important that we maintain our stance on returns for opportunity, but at the same time, we need to be wary of risk as well. So multi-asset allocation fund invest across asset class. So which means that all your investments are not lying in a single segment of the market. So and you get diversification benefit by investing in 3 different asset classes, which behaves very differently in different market environment. So that's the biggest advantage of multi-asset allocation fund. At the same time, it is done in a most tax efficient manner. As I highlighted earlier, that if somebody wants to attempt asset allocation on their own, typically challenge is identifying when to reduce or increase allocation across asset classes, because all of us are driven by greed and fear. Generally, positive news flows are highlighted during good times. At the same time, people become extremely fearful when market environments are challenging. So because of this particular element, it is extremely difficult to identify when to reduce or increase equity allocation or change allocation for other asset classes. So we use in-house proprietary financial model which guides us on asset allocation. So just to highlight a couple of changes that we made in the fund in last few years. So for example, during COVID pandemic, when market corrected 35%, we were dealing with unknown event which was extremely difficult to anticipate. But because of model guided approach, we increase equity allocation all the way to 75-80% when market corrected 35%. So such bold call is extremely difficult to take based on a view on the market. So these are the few of the benefits of multi-asset allocation category as a whole. And at the same time, we have seen that you are not compromising on performance from longer term perspective. Even multi-asset allocation fund from longer term perspective on risk adjusted basis are delivering similar or better returns as compared to equity as an asset class.
Sure, Shravan, my next question is again to you. Have you made any changes to your strategy or portfolio of UTI multi-asset allocation fund to balance out the volatility arising from external factors such as tariffs or geopolitical concerns?
Sonal, while we don't react to macroeconomic or specific events, but as part of the process, we keep reviewing portfolio on quarterly basis, and we make major changes in the portfolio on half-yearly basis. So last month we made a lot of changes in the portfolio, wherein we increase allocation to quality as well as low volatility segment of the market. At the same time, we reduce allocation towards momentum as a factor. And that's the stance that we are following for last 1 year or so, wherein because of market valuations becoming expensive. At the same time, from factor approach perspective, it is clearly visible that there are early sign of quality or defensive segment of the market performing better, because last 3-4 years there was very strong run for value as a style. So we have seen style rotating in last 6 month or so, and we believe that generally styles play out over 2 to 3 year period. So on similar line, we have made the changes in the portfolio in last 1 year. And just to highlight couple of more data points related to the fund. So allocation towards financial services sector has improved because quality and low allocation is high in this particular sector, and some of other cyclical sectors allocation has reduced. At the same time, on market capitalization basis, allocation towards mid and small cap has marginally increased as compared to large cap in the portfolio.
Thank you, Shravan. Vetri, coming to you, FIIs are now back in Indian equities as net buyers. And when FIIs come back, generally they tend to stay for long. Can we be reasonably sure that in the next few months, liquidity will not be a problem? Since FIIs are back, promoters are not selling, IPOs have dried up. So at least on the liquidity front, can one be constructive?
I'll give the same answer that I always give. You are not going to learn much about what is appropriate to do in the market by looking at the actions of others. Whether those others are foreigners or whether they are locals or whether they are somebody else. So I think it is a pointless issue to keep looking at, are foreigners buying or are they selling? I think it's more important to consider what is within your control, which is within your domain, which is your asset allocation, and secondly, where are we in the valuation cycle? I think continuously trying to figure out who will buy and who will sell is a waste of time, and I would not recommend that as an investment strategy or process to anybody. And I'm obviously talking about people who are focused on investing for the very long term, and that's the target audience that I have in mind when I make this. If there is somebody who trades in and day out, even for them, I would say find some other way. Trying to track flows is not the helpful way to actually trade the market. Your other point about the self-balancing nature of the marketplace, I'll just spend a minute on that. Which is to say, see, when there is a lot of demand for shares, somebody has to provide you those shares. And I think people miss the point when they keep looking at FPIs are selling the shares. No, the supply of new shares comes from the issuance of new shares. And one of the good things, because we want India to grow and we are excited about India's growth prospects, is that we have a capital market which takes the money from the people who have money to invest and gives it to the professionals and managers and the entrepreneurs who actually run businesses who need capital to grow their business. Otherwise, how will the economy grow if there's no capital available to the entrepreneurs to invest in their businesses? So that is where the supply of new shares comes from. So in the last year or two, we have seen a very aggressive IPO pipeline. We have seen aggressive QIPs from companies. And in some cases, because many companies in India have been promoted by PE funds and VC funds, after the company gets listed, as promoters, they no longer desire to be promoters, so they come forward and they liquidate their entire shareholding in the secondary market. So it is that supply of shares and that supply of secondary shares from people who have no continuing stake in the business, like PE funds and VC funds, which meets the demand arising from people who buy equities directly or give it to mutual funds like us, who then go and deploy it in equity. Now, this is a self-balancing mechanism, because when prices go up a lot, you find a lot more activity in the IPO market, QIP market, OFS market, PE, VC funds coming to sell down. Look at the last 2 months. The minute the market went into a sell-off, the entire IPO pipeline, QIP pipeline, OFS, PE, VC sell down, everything comes to a halt. So this is a natural balancing mechanism where when prices are down, when there is uncertainty, this transaction between those who wish to invest and those who wish to supply shares comes to a natural halt. Now, if it shuts down for a very long time, that is also not good for investors, because that means there is no capital available to businesses and entrepreneurs. Then where will future growth for the economy come from? So this is a balancing mechanism, and that is the way I would look at the stock market. It is not a Ponzi scheme in which somebody is trying to buy ahead of somebody else, buying shares in the market. That is not what the stock market is about. It is the market for allocation of capital and a transfer of resources between those who have the money to the entrepreneurs who need money to invest in their businesses.
Thank you, Vetri. Vetri, my next question is again to you. What is your take on the results that have come out from India INC, and what are your expectations for the next few quarters?
So I think the results so far have been, broadly in line. I think the financial sector has done slightly better. Some of the other sectors have not done so well, but I'm generalizing. I would just say that, I think the 9% earnings growth number that is there for FY25, remember that's March 25, so that's already in the rearview mirror in some senses. But I don't think there's too much risk to that number. The reality is that the FY26 number still remains with a high degree of uncertainty. People will model it, and analysts who have to publish forecasts will make a forecast saying, okay, one quarter company's business is impacted, 10% lower sales growth. What's the impact on my full year profitability? Or for some other company, they could say, oh, this company will benefit because India signed a free trade agreement with UK, or their competitor is a Chinese company. That Chinese company now cannot do anything, so all that demand will shift to the Indian company, so I will raise their EPS. But the reality is that this is an uncertain situation in which things are changing very quickly. So in my view, the sort of certainty we can have about these earnings numbers currently is very low, because of the uncertain times that we are living in, both related to the tariff related issues in the US, and secondly, what is happening in India at this point of time, which is the unfortunate incident in Kashmir, where so many innocent lives were taken, and India has obviously had to respond, as the leaders of the country have to respond to protect national security. And some of these may have an impact on earnings for the current year.
Shravan, what is your view on the gold as it is back in the limelight after it hit the rupee 1 lakh mark in the physical market? Is it no longer just a safe haven, but also a money-making machine? It has been outperforming equities for the past couple of years. So what's your view over here?
The significant rally in gold is driven by global growth uncertainty, mainly arising because of tariff-related challenges. At the same time, geopolitical risk also increasing in last 1 year or so. And mainly because of this, the gold has risen drastically in last 1 year or so. If you look at gold performance over long period of time, generally we will see that typically in a 10-year cycle, 2-3 years are extremely strong for gold, and then gold goes nowhere for remaining 6-7 year period. So from 2022 to 2022 in USD terms, gold was almost flattish. 10 years, there was absolutely no return. Then suddenly last couple of years, the gold has almost doubled. So gold is also a volatile asset class. Generally, one should use gold for portfolio diversification purpose. One should have 10 to 20% allocation towards gold so that overall portfolio is diversified. Otherwise, having a very strong view on gold, either positive or negative, is extremely difficult. We have seen that gold to equity ratio is also extremely volatile. And generally, sometimes it goes through the roof. And then but at the same time, whenever gold to equity ratio is expensive, forward returns are much weaker for gold. So one should not get carried away by recent performance of gold, because mainly because of these elements, gold has rallied.
Sure. Thank you, Shravan. So I will be taking one last question for today's webinar. Vetri, this is for you. How can mutual fund investors navigate current markets? For new investors, is it the right time to enter? And what should be the strategy for existing investors? Also, should investors follow a lump sum path or a SIP mode in the current markets?
All good questions for MF investors. I would say, first of all, systematic investing, and in fact, systematic investing and its cousin, opposite cousin, which is systematic withdrawal, are actually great ways for mutual fund investors to deploy capital into funds, and also to take it out. And this is particularly true of equities, which are a volatile asset class. So I would say the whole purpose of the SIP is to keep your investments going even when things look nervous and when there is uncertainty, because remember, that is when the valuations become cheaper, and we know from history that cheaper valuations are associated with better return outcomes. Whereas when things look fantastic and valuations are rich, everything looks brilliant, but the future returns get eaten into by the starting valuations, which are rich. So my first advice would be, keep your SIP going. And if you actually have income requirements for which you are doing a SWP, again, keep going, because somewhere in the future, when markets become rich, you will be redeeming less units to be able to receive the same level of income. Same principle in reverse applies to the SIP. Same amount of money is now getting you more units when prices are lower. So keep the systematic investment going. Second part on lump sum, I do think in this environment, because of the attractive fixed income dynamics that we are experiencing and the level of uncertainty in the equities marketplace, which is obviously a lot more volatile, hybrid strategies are a great way to go. They're a tax efficient methodology to get asset allocation to both these asset classes. And the dynamically managed strategies like multi-asset, BAF, and equity savings, multi-asset Sharwan spoke about, also give you the flexibility whereby the fund manager takes the responsibility for adjusting the allocation based on valuation. So hybrids would be the second way in which you could make lump sum investments to navigate the current marketplace. Finally, if you're only looking at equity funds, again, I always go back to first principles. First principle is, what is the valuation telling you, which is the more attractive segment? Valuations are telling you that mid caps are very, very expensive, small caps are rich. The only segment which is in fair value is large cap, so that if you have to invest only in equity fund, large cap is our preference. Within that also, we would say use staggered investment. From a style point of view, we think quality growth is better placed as compared to value. There are different ways in which you can play this. There are active funds and there are passive funds where you can get the benefit of a quality or a quality growth strategy. So do consider those as well. Our top sector recommendation remains the banking and financial services space, where again, there's a combination of active and passive funds available to investors. We think this is the one sector where the risks and valuations are very well placed. They are going hand in hand at this point of time. And therefore, this is one sector where we think the medium term outlook still remains attractive for investors.
Thank you, Vetri. On behalf of UTI Mutual Fund, I extend our sincere gratitude to all the viewers. We appreciate your active participation. We believe that today's session provided you with the enriching insights on the equity markets and what should be your strategy to navigate this volatility with confidence. We also believe you have a fair understanding of the investment strategy and philosophy of UTI Multi-Asset Allocation Fund. Please share your feedback on the link provided. Special thanks to Vetri and Shravan for sharing invaluable insights and addressing the questions. Keep calm, stay invested. Thank you and have a great day.
Thank you, Sonal. Thank you, everybody, for joining us. Have a great day.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.